afternoon and welcome traders. This is Long Options and I am your host, Rachel Deshelle, Senior Manager of Trading Services here at Schwab. I am joined in the chat today by my good friend, Kevin Horner. Please feel free to chat in your questions, comments, requests during the session today. And please give us both a follow on X. We post a lot of charts, a lot of market updates, different ideas there. Kevin is Kevin Horner CS. I am Rachel Dash CS. Please give us a follow there. And please also like this video to help other traders find this video within the YouTube algorithm as well. And please subscribe to us on Trader Talks Schwab Coaching. So with this class, we do make the assumption that you're already familiar with the basic concepts of options. Now, if you're not, you're more than welcome to stay around, but you may want to check out the Getting Started with Options playlist first. Now today I am excited for what is in store. This is actually coming from survey feedback. Someone's been asking about taking a deep dive in today's option statistics and how we can possibly use that as benefits to our options trading. So we're going to take a deep dive into those. We'll also have a couple leap option examples for you today. So definitely stay around. Let's hop into some important disclosures before we get started. So options carry a high level of risk and are not suitable for all investors. The information we're going to cover is for general informational and educational purposes only and should not be considered any type of recommendation or advice. And keep in mind, we will go through the paper money software application today. There are some major differences between paper and live. Now, as far as our agenda, we're going to start with our market overview. We're going to review some of our past trades, make any updates or changes if we need to. We're going to dive into the meat of our discussion, which is discussing the concept of long options, when we want to be directional, and discussing those concepts of price, time, and volatility. And of course, we're going to place those live trades. So let's dive in here to Thinkorswim with our market overview and get started here. So let's take a look at what's been just happening the past couple days as far as the price action in the S&P 500. Well, I'm going to zoom in a little bit closer so we can take a closer look here. And I'm going to also pivot the candles around so you guys can see this a little bit closer. So what we're naturally seeing right now in the S&P 500 on Friday, we saw this shooting star candlestick. Now, a shooting star candlestick is a bearish reversal type candlestick that is only confirmed when you see follow through, which is a close below the low of that high day, which we did see yesterday. So that shooting star candle had that very small body at the bottom of the candlestick, just showing that long lower wick, which reinforces that selling pressure that we saw on Friday. We saw that yesterday as well. And then today it looks like we're having a little bit of a bounce. So what would invalidate this bearish reversal candlestick is a close above this high. And you have a nice little bubble right here to remind you where that level is. So if we do see a close above the high of that reversal candle, which is 72.7252. So let's just say we make it a nice round number, 72.73. That would be our confirmation of invalidation of that bearish reversal candlestick. Now, let's say we do see a little bit more weakness here in the short term. Where may price pull back to? Well, we're going to zoom out a little bit. And the first area of support, near-term support, would likely be that 20-day simple moving average right around 70.70. That would likely be that last area. Now, let's just kind of measure that from here. It's a very, very small pullback. Let's try to measure that and see that little box that appears. So that's about a 2.5% pullback or so. Very, very minor pullback if we did have one. If we did have that, that would give bullish buyers a chance to really step in if if it drops to that level and if that level holds. Now, we do see the market still reaching overbought levels. So this is telling us, hey, momentum is really strong. We may have had a little bit of breath divergences here and there as we made our way to those all-time highs at 72.72, but momentum still remains strong, really in this overbought territory. And we know that uptrends can basically produce an overbought reading, and a stock can stay overbought or a market can stay overbought for long sustained periods of time. So that's just the result of uptrends here. It's no signal quite yet as far as a reversion. Now, I had a question in the chat. Someone actually asked me this as well. I actually had an internal associate ask me this as well. How often do shooting stars fail on average? Now, I will tell you this. This is exactly what I told one of my colleagues. I do not have the data for that, unfortunately. If and when I do get access to that data, I'd be happy to share that with you, because Thinkorswim just doesn't have that capability to tell us the failure rate of some of these candlestick patterns, unfortunately. However, we do know that there are candlestick and pattern failures that do happen all of the time, and do get invalidated. So when you have something that is invalidated, whether it's a price pattern, whether it's a candlestick pattern, that is a very, very powerful signal about what is occurring in that individual stock or in that individual market or trend. So keep that in mind. So at least now you know the levels where we did see that confirmation of that possible reversal. We saw that close below Friday's low, and we know where we would see an invalidation, which is a close above that high there. I want to actually show you something that did get invalidated as well. So let's take a look at the NASDAQ 100 and see what got invalidated there. Well, yesterday actually printed this tweezers top pattern. I talked about this in my ETF class yesterday, but essentially what a tweezers top pattern is it's two consecutive candlesticks here with relatively roughly the same highs and lows. And you kind of saw that here where these had roughly the same highs, roughly the same lows. That is typically a reversal pattern. And of course, what invalidates that? A close above the high of that pattern. So it's looking like we're gonna see a close above that candlestick pattern today, and we're making even higher highs in the RSI on momentum, striking a 76 on the RSI. So you have a lot of strong momentum there in the NASDAQ 100. And I will say this as well, even, it's NDXE. NDXE. NASDAQ equal weight is actually reaching all-time highs as well. So kind of a consistent theme that we're seeing, especially in some of these major market indexes, specifically technology, since we know it takes up a really great rating here. Now let's take a look at a couple different trades. We did get stopped out of United Health today. We had long calls on United Health with, I believe, a 20% stop. So we did get stopped out of that today. Now, our Ross stores, we did place, so we had a leap option on this one, and essentially last week, we placed a diagonal on this where we actually sold a near dated call on Ross to collect a little bit of premium in a maybe not so trending market in the near term. So let's take a look at Ross, what the chart is telling us here. And these were kind of the levels that we were looking at here. So we sold a 232.50 strike call right above this level of resistance here. Okay, so we sold it right up around here. Now, right now, it looks like Ross Stores is in this little range pattern that we see here. So a very, very tight range between roughly 230 and 224, we should say. So it's staying within this range now. IV is still pretty high. We do have earnings coming up, but it is in a few weeks. So that is definitely well after our option would be expired in this case. So right now, essentially where we're at is it doesn't show our profit and loss percentage on this page, but we still do have a bit of premium left to collect in the option. So what we'd be looking to do is essentially close that out next week in next week's class. Now, I will not be here next week because I will be out of town for my sister's wedding all week, actually. So someone else will be teaching this class, but I wanted to just kind of mention this as we are talking about managing this position. It does have 10 days left until expiration. So we want to be mindful that we are closing that option with maybe a couple days left till expiration. So that would leave us next week with 3 days left until expiration. So we'd be likely closing out that option. We can see the delta is still at 30, telling us that, hey, there may not be too much movement on this option should the stock move a dollar or whatever the theoretical amount of the stock movement is, and telling us that there could be about a 70% chance of that option expiring in the money at this time. Now, what would tell us that we may need to close out this option a little bit sooner? Well, if the price of the stock moved up to 232.50, we may want to close that option out or roll it. So essentially what our goal is going to be for next week is we're essentially going to roll this option out another 2 weeks. So that's really the plan. We're going to roll this option out another 2 weeks in time because we see that the implied volatility is still very high, relatively high in this stock, so that could be an option as well. Now, keep in mind that there is that earnings announcement looming overhead. So an options trader may say, hey, maybe this is not the best time to roll an option. So if you do want to wait, you could say, I'm just going to close this option right now and open it after earnings. Those traders that may still want to sell this option heading into earnings, knowing that typically volatility tends to decay after earnings, may just look a little bit further out of the money, may look at prior earnings reactions to see an expected move of that stock and just kind of manage the risk there. So that was another question I did have in the survey last week, was how we are going to manage this position. And we are just going to be mindful of upcoming events. We are going to make sure we close that option out a few days prior to expiration. And we are going to adjust our strategy accordingly with that. So that covers our last couple trades. I am going to look here. Okay, so I see a question in the chat. What are the pros and cons of holding it another week? Why not close it now? Well, the price is still range bound. We haven't really had a breakout from that range yet. And if I actually look at our profit and loss percentage, we're at about a 28% profit and loss percentage. I think we could squeeze a little bit more out of that. Now, some traders may be comfortable with taking a 28% profit here on a short option, but I do know that a lot of option sellers are looking for a higher profit and loss percentage, possibly. Obviously, this all comes down to the trader, but in this case, we know that probabilities are on our side. If we actually take a look at this option on the risk profile, I'm going to show this one last time. This is kind of the pros of the strategy, is that prior to expiration, if we just kind of take a look at our profit and loss percentage, we have about a 73% chance that we're going to take a profit on this trade by expiration. So all I did there was essentially put our price slice on our break even. This shows our probability of profit there. So probabilities are on our side. The risk maybe, or the con maybe, that price breaks out of that range prior to our expiration there. But again, we're still closing it within 3 days till expiration. So hopefully that helps. Now, let's see. Okay. So, I know one of the things that when I was just kind of reviewing the survey results, I got a couple questions, just kind of asking about today's option statistics and taking a deeper dive into this to possibly what this could be telling us about the options market in a particular stock and how we can use this as options traders when crafting a strategy. So there's a few important things about some of this data that we're going to see here down below. So I'm going to minimize that left sidebar so we can take a deeper dive into the today's option statistics down below here. And I want to make sure you guys can see this already. Oops. Okay. So let me know if I need to make this any bigger for you guys. Just mention it in the chat. I'll make sure I zoom into the screen a little bit so you can see the data down here better below. But essentially, what we're looking to do is first start in this upper left-hand corner. So if we just start by looking at the 52-week IV high, the 52-week IV low. This is just the yearly implied volatility high and the yearly implied volatility low. And essentially, you could even see this on the chart. So if you decide to put an implied volatility study on the chart, these are really the high and low levels that you're going to see there. Now, why this is useful is that next data point that we're going to see is that current IV percentile. We've talked about this many a times in this class. We even just got done talking about this, but essentially this is going to tell us if it is a favorable environment for buying versus selling options, because what it's essentially going to do is it's going to take the current implied volatility, which we actually see down here as a data point as well, which is 69.51. And it's going to take that IV high, which is 81.9%, and that low of 31.1%, and it's going to take this number that we currently have today and it's going to rank it on that scale. So you're taking the 31.1% as your first percentile, you're taking the 81.9 as your 100th percentile, and so 69.51 would sit right on the 76 percentage or 76 percentile there, which is essentially telling us that because the implied volatility is a little bit elevated in this stock, it's not too extreme, but it is pretty high relative to where this IV has been over the last year. This would favor an environment for possibly selling options, because we know when implied volatility is lower, the options prices are going to be lower as well because they have that sensitivity to implied volatility. Now, as implied volatility creeps up, maybe heading into earnings, maybe heading into a Fed announcement, other major announcements or events, you may see that implied volatility creep up, and so that wouldn't be as favorable for a long option holder because they'd be actually buying those options at elevated prices, or essentially overpaying for those options when it comes to just implied volatility. So the IV percentile is something we use quite a bit in this class, but if you're new to the concept like that, I hope that really helps. Now, coming down to historical volatility. So historical volatility is essentially, so this takes a 20 period average. So if you actually plot this on a chart, and we can actually take a look at this one as well. I will hide a couple of the lower indicators and we'll look at implied volatility and we can compare historical volatility. Okay, so that's something that you'll put on the chart. And you'll notice that it comes with 20 periods. So this is annualizing the volatility and it's looking at the 20-day length of historical volatility, essentially. So what this is telling us is it's telling that, hey, this is actually measuring the stock's potential price movement based off of the ranges of price movement that this stock has historically shown over the last 20 days. So that's what this is essentially used. Now, this isn't, I wouldn't say this is typically very frequently used here, but this is just kind of telling us, hey, where was the actualized implied volatility of this stock? Where have the movements actually been in this stock? And this attempts to kind of tell us that, which you can kind of see right now if we're looking at the current historical volatility percentile, it's actually relatively still low. So this stock relatively over the last 20 days or so hasn't shown a ton of volatility, which is really what that level is telling us there. So if we kind of take a look at the volume weighted average price, so the VWAP there. So that is essentially just telling us how many shares were traded at various levels. So how much volume was traded at a specific price. And a lot of traders and institutions will actually use that volume weighted average price as a way to tell whether they're underwater their positions or they're actually beating essentially that benchmark. So they use the anchored VWAP essentially as, or the VWAP, I should say, as a benchmark. Now I mentioned I had a Freudian slip there with the anchored VWAP. So a lot of traders will use the anchored VWAP as well. Now we also have that as a study on Thinkorswim, and that will essentially tell you, and you can anchor it to a specific point. I'll show you how to do that in just a moment. We've done that a couple other times in this class as well. But essentially, traders may anchor the volume weighted average price to a specific high or low or to a specific day because of earnings or something of the sorts there. So unlike the volume weighted average price, the anchored volume weighted average price isn't going to update every single day. It's still going to stay anchored to that one point that you anchored it to. And the reason why the VWAP is here, or the volume weighted average price is here, because it could give you a lot of context clues on where support and resistance lies and where you may want to be long or short a particular options trade or a particular stock position in this case. So if we take a look at the volume weighted average price in Oracle, so I'm going to actually take this one off here. We're going to take off some of these lower indicators here, and we're going to look at the AVWAP, or VWAP, I should say. Okay, so we have the volume weighted average price, and then we also have the anchored VWAP. So I'm going to show you both of those. Okay. So in the volume weighted average price, it's actually more useful on intraday charts here. So if you actually take a look at some intraday charts, I'm actually going to put it on this one. Sorry, guys. We're going to put it on the intraday charts here. Okay. This will essentially show you where the volume weighted average price is essentially for the day. And this is essentially going to plot a band above and below the volume weighted average price. And that's essentially going to be 2 standard deviations above the VWAP, 2 standard deviations below the VWAP. So essentially these bands are used as like mean reversion signals. So when you're a directional trader trading long options like we do in this class, you may see a cross of the anchored VWAP, or you may see a breakthrough or a reversion from that extended move to the upside with that 2 standard deviation move. So these can kind of give you trading signals throughout. Now, if we go back to our other chart here, I'm going to remove the volume weighted average price here as well, and we're going to look at the anchored VWAP. Since I think this kind of plays into the VWAP as well, we're going to look at the anchored VWAP here. And whoops, we added the wrong one. Okay, there we go. So a trader may say, okay, I want to anchor the VWAP to this high in price. So let me take off one of these. I think I have 2. Oh, yep, I have 2. Okay. So trader may say, hey, I want to anchor this VWAP to a specific price, maybe the yearly low or the yearly high, to see where resistance or support may come into play. So all I would do as an options trader is I would take I would hover over the candle that I want to anchor it to. I would right click on this and I would set the date to that date for the study. And this could tell us where we may run into a little bit of resistance. And I mentioned this one because this is one of the examples that we may use for a trade today. And this is kind of giving us an area where we may run into a little bit of resistance right around 206, the 207 area, because that was anchored from the highs. Now, if we do the opposite and anchor this to the lows, we can see where we may see a little bit of near-term support here, right around, where is that? Right around 170 or so would be that near-term support. So essentially, this is slated on this page because if you are essentially an intraday trader, you are essentially looking to take a long position above the VWAP, the daily VWAP. You are looking essentially to take a possible short position below the anchored VWAP, so with a cross of that. So that's kind of why you're seeing that on this page. And yes, I see Kelly mention price always returns to the VWAP. I won't say always, but price does tend to revert to that level just because that is essentially like a mean reversion type level. That's going to be the level that is going to tell you if buyers are in control or sellers are in control. And again, institutions do use that as their benchmark when they are building positions there. So keep a eye on that. Now we're going to move to the middle of the section here. And we're going to take a look at just some of the activity that we are seeing in the options. And I think that this will make more sense as we move to the right side of this page. So in the middle here, we are looking at total volume today on calls versus puts. Now we can clearly see that there are a lot more calls traded today than there are puts. So there's definitely an imbalance there. You're seeing almost essentially almost double the calls traded than puts today. And if we actually look at kind of where these are being traded, this will tell us whether we are seeing a lot of selling activity versus buying activity in the options. So if you see essentially is something that is traded at the bid or below, essentially likely you are seeing that as like option selling activity. So you're seeing a very low amount. I guess you're seeing a very low amount in because you can look at the percentages here or you can look at the numbers. So you can see traded at bid or below. We have about 20% of the total options traded today in the calls are traded at bid or below, which essentially means that uh, you're looking, because we know the ask is above the bid, right? And so we know that when you're buying, you're going to have to pay a little bit more. So you're going to be paying above the bid in that case. And when you're a option sellers, you're going to be essentially filled at the bid or essentially below in that case a lot of the times. Maybe you're filled between the spread, but the majority of times you're probably filled at bid or essentially below there. So you may be willing to accept a little bit less. And that is essentially where you may see more option sellers kind of come into play here. So if you actually take a look at the percentages here, you look at calls and you could see ask traded at or above. That is essentially, you're essentially paying a little bit more to make sure you're in that trade. So likely that is option buying activity. So just again, likely option buying activity, ask or above, and then between the market, you're getting traded between the spread. So if you actually look at the percentages of each of these, notice that on the put side, 16%. So that's traded at ask or above. That's the smallest percentage out of all the puts, meaning there's likely the least amount of put buying going on today. There is likely a more activity on, well, you have a lot traded between the market, obviously, but there is more traded at the bid or below, which means there is likely more option put selling activity than there is put buying activity here. So that's kind of the difference there. Now, excuse me, I'm getting sick again, you guys. Um, Now on the call side, if you look, it's exactly the opposite. You actually see more traded at the ask or above than you do at the bid or below. So on the call side, it's actually telling us that there may actually be a little bit more call buying activity happening versus call selling activity happen. And then you have about even numbers traded between the spread because you're obviously going to have that too. You have the market maker that's going to meet you halfway some of the time where you're getting traded between the spread there. So just from this analysis here, from where these are occurring, you're definitely seeing, like I said, a little bit more call buying activity, more selling put activity today than you're seeing vice versa. And so what does that tell us? If we're seeing some more put selling activity, more call buying activity, that is telling us that there is some bullish activity that is occurring in the options market with Oracle. And just to kind of look down here even, the delta between will tell you that as well, because if you are, we know in this class when we look for a delta that is a little bit larger, we are looking to be a little bit more directional. We may be looking to buy an option with a little bit of a larger delta. You're seeing the meat of the larger deltas really occur right between 41 to 60. And if you look at that difference within the puts, you can see that's very lopsided. So there's not a lot of high delta conviction or a lot of high delta trades within the puts going on. There's a lot more high delta trades going on within the call side. So again, that's a little bit more confirmatory that the sentiment here may be bullish. Now, another thing here, you're seeing a very large amount of deltas between 0 and 20. So one that could be hedging activity, far out of the money options. That could be that, but also when you're looking at a delta between 1 and 20, the probability that that option expiring in the money we know is very, very small, very slim. So likely those are going to be option sellers. And we know selling puts is bullish in that case. So you're looking at, or at least bullish to neutral, and you're seeing a very high amount of deltas there within the put. So again, more bullish activity that we're seeing there. Now, if we climb over to the sizzle index here, the sizzle index is actually going to look at the total number of, or the, I would say, total volume of calls and puts traded today compared to the average of the last 5 days. And so a sizzle index of 1 would tell us that, hey, this volume in the activity today is the normal for the last 5 days. If we're seeing a sizzle index of 1.19, that's telling us that there's a 19% increase in option activity today than there has been in the last 5 trading days. If you look at the call sizzle index, take the same thing, but for the calls side, there's about a 12% increase in call activity. There's also a 34% increase in put activity. So what does that tell us? There is an increase overall in activity in Oracle. So the options market is definitely telling us something. And we looked at some of the data. It could be telling us that there may be some bullish activity underway. Now, something else, we look at the volatility sizzle. That does the same thing. So it looks at the current level of implied volatility and compares it to the average of the last 5 days. There's a 6% increase compared to the last 5 days. Stock sizzle actually takes the stock volume and it compares that average to the last 5 days. So what you're seeing is actually, well, the market is still going to be open for another 2.5 hours or so, but you're actually seeing the stock volume is very, very light today So you're seeing a decrease in the stock volume over the last 5 days, but you're seeing an increase in the options value. So that's kind of notable as well. The other thing that we are seeing here is a put call ratio. Okay, so a put call ratio is taking the total number of puts today traded compared to the total number of calls traded. And this essentially gives us a reading. Now, to put it into perspective, there is always more call activity, or I guess I shouldn't say always, but there is a tendency for more call activity in the market than there is put activity because of the natural bias of the market. So, the average essentially put call ratio is around 0.7. So 70%, that's the average. If you're going to see a put call ratio at 0.5, so 50%, that means that essentially there is a lot more calls traded than puts, and that could be an extreme bullish reading. So when you see it near 0.5 or below 0.5, that's an extreme bullish reading. Now, if you see it above 1.0, because we know puts are in the numerator, calls are in the denominator. So if you're seeing a put call ratio of 1 or greater, that's an extreme bearish reading. Now, what can these extreme readings tell us if we have a put call ratio below 0.5 or above 1? That could actually be a contrarian signal. So if we're seeing an extreme to the call side, so below 0.5, that could be telling us that, hey, maybe now if we're seeing something to develop in the trend, this may be a good time to maybe hedge a little bit. So on the call side, below 0.5, extreme bullish reading, that may be a sign that tells us, hey, maybe there is a time for a hedge, look for some breaks in the trend. Then on the other side, when you're seeing extreme put activity, that could be a contrarian indicator that tells you, hey, maybe we're at a possible bottom. This could be a possible reversal. So kind of think about it like as tops and bottoms in that case. And so that may be the time where you may want to go fishing, or trader may want to go fishing in the call options arena. So right now, still a very bullish reading in Oracle, not necessarily an extreme reading yet. So with a couple minutes we have left, let's take a look at this trend and what we're seeing may be developing here in Oracle. Or actually, let's do, we're going to look at, yeah, we'll stick with Oracle. We'll stick with Oracle. Okay. So with Oracle, we're looking at the trend here, and what can we see? Okay, so we're going to use the 20-day moving average here kind of as our indicator. So where may we be running up into a little bit of resistance? Okay, maybe 189. We have support down here at this gap ledge right around here. Now, Oracle has been a stock that has had this bottoming process underway. It's changed its short-term trend. We saw that it is also trading above its intermediate term average, above the 20-day, above the 50-day. We have a couple short-term levels here, but we are seeing that bottoming process that did complete in Oracle. We are seeing a higher high that had been made from the lower high. We're seeing a lower or a higher low being made from the lowest low. So I'm actually going to place a leap option in Oracle today. So we're going to actually take a look at this one and place a leap option on Oracle. So we're going to look more than a year out. And again, with leap options, they're essentially just options that have an expiration of a year or longer. So you're actually going to put on the hat of a long-term investor when it comes to the leap options. The fundamentals are going to matter a little bit more. The trend definitely matters. But this is definitely kind of one of those strategies where you can say, hey, this is where maybe a level that I want to get in on this stock, but I don't necessarily have enough cash to essentially buy 100 shares of this particular stock, but I am bullish in this stock in the long term. So I do want to participate in a possible run up and repair that could be underway in Oracle, this software stock. So what we may be looking to do is trade an option that may be slightly in the money here. So we may be looking at a 180 strike call here for roughly a year out from expiration. We can see it has a delta of 64 here. Now, remember the implied volatility was a little bit higher, but do keep in mind that implied volatility over the life of this option is going to fluctuate quite a bit. So this is going to fluctuate. We are going to have that sensitivity to our implied volatility in this case. But again, we're going to hold this stock through multiple earnings announcements, Fed announcements, all of those types of events. So with LEAP options, don't put as much stress, or traders won't put as much stress on the volatility levels or implied volatility levels as long as they're not at a level of extreme. So in this case, we're going to look at placing this order. We're just going to buy one contract here of the, whoops, I need to go right click, buy custom with stop. So we're just going to look to buy one contract of Oracle, the 180 strike call. We know that there's going to be a little bit of time decay, but not too much time decay because this gives us over a year as far as our expiration date. We're going to make this good till canceled, and we may be looking to give ourselves a little bit of room here and maybe looking at a 20% or a 25% stop to the downside. So if I take 47.95, which could be my entry, I multiply that by 0.75, that gives me an area on where I could possibly get out of that option with a 25% drawdown on the option. So we're going to give ourselves a little bit of space, and we're going to put in our stop there. Now keep in mind that these stops, there's no guarantee that they're going to get filled at or near the stop or activation price. This price will fill, or this will activate, I should say, when the asking price touches this level. So keep in mind, there is going to be a risk if that stock gaps down overnight. You may not get filled at a price that is near your desired price in this case. So with this LEAP option, we're going to manage it the same way that we have managed our other LEAP options. So one of the main ones that we have is Ross. We are essentially going to trend follow this option to the upside. If the delta does get larger, this option moves deep in the money around an 80 delta, that's when we're going to roll that option out to a further a smaller delta, a little bit smaller delta from where we started with. And the reason why is because sometimes the liquidity can lessen, the spreads can get a little bit wider when that option moves too far in the money. So we are going to shift it that way and then move our stop up as well. So I'm going to hit confirm and send this to our long options class there. And perfect. Okay. So we covered a ton today, and this was straight from your feedback from that survey. So I would highly recommend when you see the surveys, definitely fill those out. If you have other feedback, please feel free to share with that, share that with me on X. You can follow us both on X. He is Kevin Horner CS. Thank you, Kevin, for helping us in the chat. And I'm Rachel Dash CS. Please like this video. Help other traders find this video too, because using this activity, this options activity, is definitely crucial when you are figuring out the sentiment and the activity that is going on in the options when you are crafting your option strategy. So please subscribe to us on Trader Talk Schwab Coaching and have a great rest of your day.